welcome you to the meetings, into this particular session. I'm impressed to draw up this early to come out for this session, and glad to have all of you here. I'm going to talk for a little while on this subject, but my plan is to leave plenty of time at the end for a Q&A. So if you have any thoughts along the way, slow them up, and I'm sure they won't be unique. So this topic is one I think that those of you, presumably all of you, since you're here, who do work in the area of corporate finance, encounter problems associated with endogeneity and identification in your empirical work. And so I thought I would start, like I do sometimes in a classroom setting, start with a question and say, among all of you who have submitted papers in the field of corporate finance, how many of you have had a referee or an editor say, I don't buy your identification strategy, or something to that effect? That's all, really? Does that mean the rest of you haven't submitted papers yet to journals? I think you're hard pressed in corporate finance to do work without that endogeneity problem coming up, without your identification strategy being criticized in some way. And so it begs a lot of questions, I think, in terms of how can we do this research in corporate finance in a meaningful way while still dealing with this endogeneity problem. Now, a lot of people complain about how they're treated by referees and editors on this issue and refer to so-called identification police. So an alternative title for this talk might be eluding the long arm of the identification police. But my idea today is not really to talk about econometrics. I mean, there's been several very good tutorials at the FMA over the years on that subject. I'm more interested in talking about sort of research design issues in empirical corporate finance with a particular eye towards expanding the types of studies that we do. Because one of the concerns that I have is that this identification problem has become so pervasive in our work that it's sort of narrowed down the styles of papers that we think are acceptable to the journals now. And as a result, we're potentially limiting the scope of questions that we're asking in the field. And I don't think that would be a good development if that's the case. So what I'm going to do is the following. Just sort of talk a little bit at the start about the basics of what the endogeneity problem is. I think everyone's pretty familiar with that, as well as some of the econometric responses that exist in the literature. And when I talk about those, again, this isn't a talk about econometrics, but more just to point out that none of these are perfect solutions by any stretch. They all have some limitations to them. We're never completely solving the problem. But what we have done is sort of narrow down the set of papers, I think, that we tend to do in empirical corporate finance. And that raises these concerns that I alluded to a couple of minutes ago. And then what I'm going to do is sort of apply some of these ideas in the field of research that I've been doing more work on lately, which is capital structure research. So I'm going to talk about alternative different types of research designs, all of which I think are useful in terms of what we're really trying to do in the profession, which is expand the set of knowledge that we have on a particular topic. None of them are perfect. Many of them will suffer from identification problems, but that doesn't mean they aren't useful. And so I think this is where I'm going to try to convince you that we need to re-expand the types of studies that we're doing if we really want to get at some of the big questions that we encountered in corporate finance. And I'll run through several examples from the recent capital structure literature that I think illustrate the points that I'm trying to make, both in terms of what we can learn from those types of studies as well as what we can't learn, and how you can think about doing studies like that in a way that will be viewed as useful by the journals and therefore publishable in the literature, and then try to draw some conclusions from that. Okay, so the basic endogeneity problem, I think everyone is pretty familiar with. A lot of the research that we do in corporate finance is really geared towards trying to establish some causal connection between some variable, x1 in this case, and some dependent variable that I've listed as y in this particular case. So you think of it in a regression framework. It doesn't have to be a linear regression like this, but it's easier to represent this way. We have the association between y and x1 while controlling for some vector of x variables that we think are other possible determinants of y. And we're trying to establish whether x has some effect on y. So common examples in the corporate finance literature, the question might be, does debt constrain investment in some way? So we can test the association between debt levels and levels of investment. Do taxes affect capital structure? So it's the association between some measure of the tax obligation that the firm is facing and the leverage choice that they make. Or does governance affect value? A notable example of that is a connection between ownership and some measure of value, like total skew. Right? So these are typical tests, all of which suffer from this identification problem because we don't know whether there's a causal connection between this variable x of 1 and the dependent variable, or whether we've got some correlative variable. So ultimately the issue is whether there is some correlation between this x1 variable and the error term of this model. Now obviously, if we had some idea what these omitted variables were, we put them in, and then we could take care of the problem. But the issue is we don't know what they are. Right? And it's very easy for a referee or an editor to say, well, there's something out there that's correlated both with your x1 variable and this dependent variable that you're trying to test for. And so in the end, I still buy your identification strategy. I don't buy that there is a causal connection between the two. So for example, if we run regressions of investment on leverage, we will find that the higher is the leverage, the lower is the level of investment. Right? Now it could be because debt constrains investment. Right, or it could just be that firms that have poor growth opportunities tend to have higher leverage. That's what we would predict they should in capital structure models. Right? And we just simply can't perfectly control for growth opportunities. So even if we have some proxies for growth opportunities on the right-hand side, if we can't perfectly control for them, the omitted part is embedded in the error term, and we have this positive correlation between debt and the error term, and we're stuck. So what do we do about that? So where I think the profession has really made some big strides in the last 10 to 15 years is in understanding econometrics and the application of these econometric methods to problems associated with identification. Right? So it's fairly standard now to see panel data techniques used. Firm fixed effects, industry fixed effects, year fixed effects. Those are useful to a point. And we've got some omitted variable that is firm specific and doesn't vary through time. Firm fixed effects are taking care of that. Right? We're good to go if that's the case. But the problem is we don't know that that's the nature of the omitted variable. So if there's some firm specific but time varying variable that is the source of this endogeneity, the panel data techniques aren't really going to do it for us. And again, unless we really know what the omitted variable is, which we can't by definition, we're still going to be subject at times to this criticism. Now, what panel data techniques are useful for is that they're at least limiting the scope of the endogeneity problem. You can't be criticized for omitting something that is just some factor that isn't going to vary through time within a firm. you have control for that. So it's a bit of a solution in that sense, but it can never completely take care of the problem unless we really know precisely the nature of the problem. Right? Another possibility is some sort of regression discontinuity technique. Right? So here the idea would be that we have some sort of threshold event, and when we cross this threshold, we can test where there's a difference in behavior. So an example would be if you're trying to test whether creditor control has some impact on real investment decisions, let's say something like Java and Roberts in their paper. So you can observe a covenant violation, right? And the question is, when you cross this threshold and violate the covenant, right, do you observe a difference in behavior? Now, the nice advantage of the regression discontinuity technique is that right around that threshold, you can plausibly say that firms on either side of that threshold are roughly the same. Their characteristics are roughly the same. And if you can make that claim, then this is a pretty solid way to try to deal with the endogeneity criticism. The limitation here is that you don't come across that many clean threshold types of events that you can really use in the context that we study in corporate finance. If you can find them, it's great. By all means, use them. But my experiences are difficult to find, and therefore, not often do you come across situations where that's really going to help you out with your identification problem. Third possibility is to run through some sort of matching model, some propensity score type of approach. And again, that's great if you can identify what you think are the most plausible set of factors, so you can match up firms and do a difference in difference sort of approach. But again, almost by definition, these can't be perfect because we're talking about correlated, omitted variables that we don't really know what they are. If we know what they are, sure, we could perfectly match on them and run this type of test, but not knowing what they are leaves us a little bit in limbo. Instrumental variables, another possibility. Again, it has some limitations. We need some variable that's going to satisfy both the relevance criteria and the exclusion criteria. Relevance is pretty easy to demonstrate most of the time with an IB, but it's really easy to criticize instrumental variables on the exclusion part. And so they're difficult to find. Good instruments are really difficult to come across. They've got to be based on underlying economics, but there's no great test for that instrument, and so you're always open to this criticism that you just got a bad instrument. And so all of these techniques are useful. All of them should be done in different contexts, but we can never use these techniques and think, okay, we've solved the endogeneity problem. We don't solve it using econometrics. So where the profession is kind of headed more towards is the fifth one, which is natural experiments. Right? What's great about natural experiments is that you can identify some plausibly exogenous event. If it's truly exogenous, then you can do sort of a different diff analysis and claim causality in a pretty credible fashion. Right? And because you can do that and defend it much more easily than some of the others, this has become sort of the holy grail in a sense in terms of doing empirical corporate finance. But it's not without problems, I think. And these are the concerns that I was alluding to before. I think the way we've started to head is to have this general belief that every study's got to have some clean natural experiment or some perfect instrument, otherwise the study's not doing it. Just a quick check on SSRN that I did, put in natural experiment in the abstract of papers. I get over 1,600 entries of recent papers in the field, mostly in corporate finance, where you see that. Now, I want to make sure I'm clear that I'm not at all criticizing natural experiments. I mean, they're great if you've got them and they fit the question that you're asking, but my concern is sort of twofold, is that what you tend to see a little bit more often now than you saw before is that authors are kind of starting with the experiment rather than with the question. And that's not quite the way you want to go about doing research. I'll say more about that in a minute. In a way, it's kind of similar to concerns that have come up over the years as sources of data have changed. Back in the dark ages when I was getting my degree, there wasn't a whole lot of machine readable data. And now, most data is machine readable. And as a result, you saw over time, or at least my perception, is that you saw authors start to shy away from hand collection of data and say, well, they wouldn't do the study unless they could identify a readily available data source. And then even to the point where they'd just be looking for data all the time, see the data in good machine readable form and say, well, let me figure out something to do with this data. Again, that's not really the way you want to conduct research. You want to start with the question. So it's been alluded to sometimes as, are we reaching the point where we have sort of unnatural obsession with natural experiments? And I think we've got to have these things all the time. And so that's one concern, that it's sort of changing the way that people go about doing research. A related concern, though, which I think is the bigger one in terms of the field or the profession in general, is that it can be very limiting in terms of the scope of the questions that you ask. Like there's some big questions in our field that should be addressed. Right? And when these big questions come up, maybe there isn't a perfect natural experiment. Maybe there isn't a perfect instrumental variable that you can use. And if people think, well, unless I have that, I can't do this study, then those studies don't get done. But we're giving up a lot if that's the way we approach research, I think, in the sense of really important questions that we could shed some light on and just incrementally move towards a richer knowledge of some of these questions. So when I talk about the capital structure research, I'm going to try to highlight a little bit more what I mean by that. Right, so let me compare those concerns with what I think most of us in the room would say this is how we would advise PhD students as to how to go about doing research. Right? First and foremost, say, well, you want to identify an interesting question. If students come and talk to me, that's frequently the first thing I'm saying, well, what's the question that you're asking people? And I've noticed this even in terms of interviews at the meetings, FMA or AFA meetings, where you interview new candidates and you ask the candidate to launch into their spiel about their research. And the first thing they do is they go straight to their experiment. Like, this is an experiment I'm running. And that's not really what most people want to hear. They want to know, well, what's your question? What's the question you're really trying to get at? And this is the way I think, as I said, most of us would probably advise students to do research by first identifying an interesting question. Right? Once you've got that, all right, then you should be thinking about developing hypotheses from first principles, from the ground up. Right? Develop a plausible, testable set of hypotheses. Then, and only then, I think, once you reach that point, then you start thinking about your experimental design. Well, what's the best way that I could go about trying to shed some light on this particular set of hypotheses? Right? And this is the part, just to reiterate what I said a couple of minutes ago, I think this is the part that at times looks like it's getting flipped in the profession. Is that too many studies are starting with the experiment and then moving on from there. Right? So once we identify this experimental design that we think is the best for shedding some light on, then we eventually get some results. We got to let the data speak, but we got to let the data speak in a way that we're well aware of what the limitations of what we're doing. And this is more of a criticism of of referees than it is of authors at this point is that you tend to see a lot of referees who are unwilling to accept limitations and say, well, if you don't have a perfect identification strategy, I'm going to reject your paper. That's sort of leading people to think, well, I got to have a perfect identification strategy, otherwise this paper is not worth doing. I'm not sure that's the best development for our profession, because there are a lot of things that we can learn from studies that are imperfect. Right? Because let's be honest, every study is imperfect in some way. And if the particular way is you can't necessarily identify causation in your study, it doesn't necessarily mean that the study isn't worth doing. But it does mean that if you do the study and you fail to note those limitations, you probably deserve to be rejected at this point. Right? You can provide evidence, you can interpret that evidence, you can understand that maybe you can't imply causation from that set of evidence. If all that is kind of laid out for the reader, then the reader can decide in the end, well, given all these limitations, do I feel like I learned something from reading this study? And if the answer is yes, and you learned enough, then the journal should be willing to accept that paper, and they do. I think they do, and that's important. Let me just back up a second. There's one more issue that I wanted to note on this particular slide, using the example of business combination laws. Now, so this is a natural experiment, I think, that has had a lot of success in the profession. And so let me be clear up front, I'm not criticizing this natural experiment. It's a good one. And the way it's useful is in the sense that if you think about types of studies in corporate finance, one big class of studies is asking whether governance has some causal impact on value or managerial actions. And these are interesting and big questions, I think, but they're tough to get at from an identification standpoint. So a clever natural experiment is the introduction of these business combination laws, and these laws are sort of staged over time in different states. So it makes for a really nice exogenous shock to governance that we can then connect with some sort of outcome variable. And so it's got a lot of the attributes that you're looking for in a natural experiment. Now it's also got, it also raises some of the concerns that you'll always see in natural experiments as well, because none of these, what we call natural experiments in a social science, are never really pure natural experiments, because somebody had to decide that we're going to change these laws. The laws are not purely exogenous, they're endogenous in some way, and maybe what's driving the change in the laws is correlated with your outcome variable. But these authors who have done these studies of business combination laws have been well aware of those limitations and made a plausible case that they're not interfering with the interpretation of causation. Right? So it's a pretty nice, clean, natural experiment. But it's probably one that I've seen repeated the most times of any sort of natural experiment. It's been repeated in some good ways, right? But it starts to run out of juice after a while, because you see some big questions like, does governance affect value? Does governance affect investment? Does governance affect innovation? These are all very useful applications of this natural experiment. But what tends to happen in our profession is that everyone says, well, I really need a clean natural experiment. I can see from these publications that the profession seems to accept this one as a useful natural experiment. So what can I do with this one? Again, you're starting with the experiment then, rather than the question, and we start to get into some really marginal questions at this point. You just keep following this path, you eventually start seeing studies that are like, what's the impact of governance through business combination laws, and what the CEO had for lunch on Tuesday. Well, yeah, I guess you can establish causation with this natural experiment, but now you're asking the question nobody cares about it. So you have to worry about that a lot, and you run into this problem precisely because you're starting with the experiment that you think will pass muster with the journals instead of starting with what is the interesting and big question. All right, so now let me talk a bit about capital structure research as an example of some of these themes that I'm talking about. So there's nothing particularly unique about capital structure research with respect to these identification problems. I'm choosing it simply because I've been doing papers in this area, and so I know this area a little bit more, and you'll see in some of the examples that I'm using in my own papers. It's not because I think these are the best papers in that field, but I know these papers better, and they're representative of some of the points that I'm trying to make. But there's some really fundamental questions in capital structure research that, amazingly enough, after all these years, we haven't done a great job of answering quite yet. And we don't really have a great idea of what are the primary determinants of capital structure decisions. We have some pretty good theory about what sort of market frictions ought to matter: taxes, bankruptcy costs, agency costs, asymmetric information. But it's difficult. It's proven difficult to establish what factors are really first-order determinants of capital structure decisions, and part of the issue has always been proper identification. Now, another whole segment of this literature is just sort of getting at static models versus dynamic models. I'm not really going to talk that much about that because it's not as directly relevant to the topic today, but that's also a challenging aspect in this literature. But what you see, what I want to talk about in the rest of the time are a variety of different sort of research approaches in this field that I would argue are all very useful. Right? They all give us some information, different aspects of the set of information that we need to ultimately draw some conclusions about capital structure. And only one of them falls in this category of natural experiments. What's important, I think, to note is that even though all these are potentially useful, they all have different limitations to them. And so you're getting different pieces of information from them. And so you can't view them as being able to draw the same sort of inferences in terms of causation, but you can view them sometimes as telling you a little bit more about what's first order and what's not first order, and I'll be a little bit more precise about that in a couple of minutes. So the classic approach, of course, is to just do an all-us type of regression. You've got leverage on the left-hand side, you've got a set of your testable determinants on the right-hand side, and other control variables. You might also estimate this using panel regression techniques to try to control for base effects of some sort. And the literature's got tons of studies that fit into this particular category. But there's proven to be two main problems. I mean, the one is the identification problem that we're primarily focused on. But as a practical matter, too, the second problem has been that it hasn't proven that fruitful. You know, we end up identifying some relatively vague factors that seem to matter. You know, we say that leverage is associated with profitability, growth opportunities as measured by market book ratios, usually firm size. That's great in a way, but when we think about relating that to capital structure theories, we find ourselves in this trap where it's consistent with multiple theories, even multiple classes of theories between static trade-off models and pecking order models. They can be reconciled with this set of observed determinants, and so in the end, we feel like we haven't learned that much at times with this literature. Right? So the way the literature has progressed, I think, and this is a useful progression, is to think about different types of empirical approaches that can shed some additional light. Now, one type would be the natural experiment. And can we observe some exogenous shock to one of these hypothesized determinants while the others are held constant, and see whether that shock seems to elicit a reaction from firms in their choice of capital structure. Right? That's one way to shed some light on a specific factor. Right? Another possibility is to conduct what's really more of descriptive data analysis type of studies. Now, these next two, descriptive data and longitudinal types of studies, are kind of similar in the sense that you would probably characterize them both, well, one certainly by the name, but both of them are sort of descriptive work. And by that I mean they're not generally set up as being specific hypotheses that are tested in sort of a traditional scientific way. And sometimes these kind of studies get a bad name. You see people use descriptive as a pejorative term. So that study is descriptive. But I would argue that this has a place in the set of research approaches. And in particular in capital structure, I think it's been useful. I'll give you a couple of examples of how they have been useful. Longitudinal studies are similar in the sense that if we look over a long period of time, whether capital structure has changed over that period of time, or whether we can somehow connect that with changes in either firm or macroeconomic characteristics in a way that is consistent or inconsistent with what we think of as the theory underlying this. So the longitudinal models are a little bit like natural experiments in that you can have over a long period of time shocks to multiple possible determinants of capital structure. In a sense, think of it as sort of a horse race among these different factors as to what seems to be first order and what's not. Another approach might be structural models, right, where we really try to get into the dynamics of capital structure policy over time. Can we specify some sort of objective function that the manager is maximizing, specify a set of exogenous determinants as well as a set of endogenous variables that can be connected with leverage, and so in a sense specify the nature of the endogeneity problem, and then take this to the data through some structural estimation to see whether the data seem consistent with that, with the predictions from that structural model. Lots of good examples of that in the recent literature as well. And last, and certainly not least, is that I think there's room in this literature for clinical or case study sort of approaches. Now, it's difficult, I think, to do a standalone clinical study. Years ago, the JFE published lots of those that sort of backed away from that over time. But I think clinical studies are very useful in conjunction with some of the others. And I'll give you some examples of that, how you might combine sort of a descriptive data analysis or longitudinal study with clinical analysis of the subset of your data in a way that sheds a lot of light on what's really going on. It can really help you tease out the identification issue as well. And so let me give you a few different examples from the literature that highlight the use of these different approaches. And in doing so, I want to ultimately make 2 points. One is that each of them are useful in shedding light on an aspect of the capital structure problem. And then secondly, I want to make sure we understand that each of them also has limitations. And so you have to be careful when you do these studies as to understand what you can and cannot conclude from the type of study that you've chosen to do. Right, so one approach, as we mentioned, is a natural experiment. Right, a good example of that are these studies that have looked at staggered changes in income tax rates, either across states within the U.S., like the Heider and Lundqvist paper, or across different countries throughout the world, like Faccio and Xu have done. So it's sort of a classic natural experiment, diff and diff kind of approach, where you've got the change in data, change in leverage on the left-hand side as a function of the change in the tax rate, that's the T variable, set of firm-specific variables, and denoting with X and I's, and industry-specific variables as well. Right? So you're trying to control for all these other possible determinants of leverage. You're seeing a shock to tax rates, right, at a point in time. Do you see firms respond with changes in leverage? Right? Now, as with most natural experiments, as I mentioned before, they're not pure natural experiments, so there's still a little bit of endogeneity that you worry about in this, and so you might worry that somehow there's still some systematic differences that you cannot control for between firms, say, within states that had the tax rate change versus those that didn't. So you'll see clever ways to try to get at that by looking right around the borders between states, look at counties that are right along the border, with the idea being that the economic conditions of companies on either side of the border have got to be roughly identical, or borders of countries in the case of Faccia and Shoe. And so you do your best to hold constant all the other possible economic determinants of this leverage, but one group has the shock to tax rates, the other group does not have that shock to tax rates. Do we see a difference in leverage as a result of that shock to leverage? So if done in a correct manner, this type of study is really useful for getting at this causal connection between this factor, taxes, and capital structure change. What it can't do, right, is tell you something about whether taxes are really a first order consideration or not, because you've, by definition, if you've done the study right, you've held all these other factors constant. And you've isolated in on the tax rate. Now, again, that's not a criticism of this type of study. It's just a point that in doing this sort of study, you've got to be clear on what it is your goal is. Like if you're going into the study saying, well, my question is, I want to identify what determines capital structure, this isn't really doing that for you. Right? If your question, though, is, do taxes have an impact on capital structure at the margin? Yeah, this is the way you want to do it. You're able to isolate in on the causal impact of taxes on leverage decisions. It's very useful in that sense. But it's a subset of the information that we're trying to put together in order to get a bigger picture of what's really happening with corporate capital structure decisions. All right, so that's one type of study. All right, so one of the other types of studies I talked about is descriptive data analysis. Right? Now, in some respects, this is a tricky way to go about doing empirical research because, as I said before, you're not necessarily starting with very firm hypotheses, but rather it's a little bit more exploratory in nature. So the goal ultimately in a study like this is to provide enough information to the reader that they somehow will think differently about capital structure than they did before. And if they don't feel that way, then you don't have anything. You just describe a bunch of data that everyone shrugs their shoulders and says, well, so what? Who cares? So I'm going to give you a couple of examples of this type of work, one of which is my own with Steve McKeon that was in the RFS a couple of years ago. And so here, the approach we took in this study is to say, well, let's get away from thinking about it in sort of a standard regression framework where we're looking at a bunch of right-hand side variables, determining what's on the left-hand side, which is leverage. Let's instead, let's start with the left-hand side. Right? So let's try to observe some major discontinuity in the financing behavior of the firm, and then back out what seems to be driving that change in financing behavior. So the way we went about doing this is to say, okay, well, let's first identify firms that have what we call proactive change in leverage. And by proactive, we simply mean that they actually issued debt in order to change their leverage, as opposed to they bought back shares or had some other action that just ended up causing their leverage to be different. We want them to be proactively issuing debt in a way that changes their leverage ratio. And the second aspect of that was that we were requiring that the resulting leverage ratio was at least 10% above some estimate of their target, where the target is being estimated using sort of standard empirical models of capital structure. Right, so we put in the second requirement because we thought, well, this is sort of a unique and challenging situation for the literature in the sense that we've now got firms that are deliberately taking action that pushes them well away from what we think of as their target leverage ratio. Right? And so we're just asking two very simple questions subsequently. Why did they do it? What looks like is the underlying motivation for undertaking this leverage change? And then secondly, how do we see the leverage ratio evolve subsequently? And does that tell us something about whether they seem to be targeting a particular leverage ratio? Right? So what do we find? So, well, first of all, what we tend to observe is that they seem to be doing this for reasons of financing specific investment needs. Sometimes it's capital expenditures or R&D. Sometimes it's more working capital considerations. Right? But these don't appear that they're borrowing in order to, say, for example, buy back shares. It also doesn't appear that they're borrowing so that they can move to some new target leverage ratio. Right? But also the second main result is that when you look at what happens after this initial jump in leverage, right, it looks like they're starting to move back towards what we think is the target leverage ratio, but they're in no hurry at all to do it. Right? It's a really slow adjustment back towards the target, and even though they have opportunities to be a little bit more proactive about it, and they could have moved back to the target quicker in some cases, they don't. You sort of see it drifting back down. And what's kind of interesting too is that when we see subsequent situations where they seem like they have a need for funds, they go out and borrow again. Even though they're still well above their target, they get even further above their target later on. Right? So what does all that mean? Right? How is this then a useful study in capital structure? Some of you might think it isn't a useful study in the capital structure. Why do we think it's a useful study to do? Well, first of all, if you think about it, what this seems to imply that this managing towards some sort of stationary or static target leverage ratio doesn't seem to be a first order concern for managers. They don't seem to be behaving in that way. Right? Well, that's kind of interesting in the sense of what we think of in terms of capital structure models. Many of them are sort of stationary, static target sorts of models. And this is kind of saying maybe we shouldn't be thinking along those lines in terms of theoretical capital structure. Right, the second aspect of it is that it seems to be pointing towards financing of investment needs and then the subsequent evolution of cash flows as being more first-order drivers of the dynamics of leverage through time. Right, now, let's be clear that when you do a study like this, we in no way can claim some causation in anything that I just described to you. And we have to be really careful as we're laying out these results that we're not at all making any such claims about causation. Right? But why might it still be useful? Well, in a sense, what we're trying to do is we're sort of reducing the scope of the models that are really plausible models for how firms really behave with respect to capital structure. And if we can do that, and if we can do that sufficiently, then we feel like, well, that's a contribution that is useful to the capital structure literature. And fortunately for us, a referee and editor agreed that it was useful enough. Right. Now, a similar sort of example is this recent paper by D'Angelo and Roll that I don't think it's out yet in the Journal of Finance, but it's forthcoming in the Journal of Finance. So what they do at a very basic level is fairly simple. They're really just describing the variation in leverage ratios within individual firms through time. Now, why should you do that? Why would you start a study like that if you think you're going to contribute to the capital structure literature? Well, the idea is that most of the models and most of the thinking, I think, within the profession through time has been that capital structure within firms is reasonably stable through time. right? And where you really get a lot of variation is in the cross-section. Right? And that's kind of reflected in the type of work that you see in the capital structure literature. So most of the models and most of the empirical work are designed to try to explain that cross-section. Why the cross-sectional variation? Well, that's not necessarily a good approach if what's really going on is that a lot of variation is happening within the firm over time. If that's just as important as the cross-section, then we've sort of got to rethink what our models are really saying and how we're approaching the empirical works. That's sort of where the study is heading from the outset. Again, the idea is it's descriptive data analysis that's trying to describe the data in a way that's going to cause people to rethink how they're approaching capital structure. And if they're finding something that's unique enough that does cause people to do this rethinking of how capital structure is determined, this is a useful way to approach the problem. Right, so what do they find? Well, first of all, they do find substantial instability in the leverage ratios of individual firms through time. Right, a lot of variability. Surprisingly, I think, to a lot of people, a ton of variability in individual firms. They do find episodes in which firms look like they have relatively stable leverage ratios, but those are pretty limited to time periods in which the leverage level is really quite low, oftentimes zero. So you see a lot of stability over things. Some firms have no debt, and they keep no debt for a while, or really low debt, they keep that for a while. And that's when you tend to see stability. When leverage is higher, it tends to be bouncing all over the place. Now, why does it bounce all over the place? Well, they find, like we did a paper with Steve McKean and I, they find that it seems to be connected with episodes in which there are strong investment needs. Right? And this is where they sort of, they do a really nice job of combining some clinical or case-based evidence to complement what they're doing on a large-scale basis in terms of documenting instability. Right? They dig into the data and identify, well, what seems to be the underlying cause for these individual firms for increasing their leverage when they see it increasing or decreasing when they see it go down. And they find pretty strong evidence that it seems to be associated first with the company expansions, due to changing economic circumstances for those firms, and then subsequently reduction in leverage in those time periods in which it's actually either excess cash flows that they're producing or they're actually retrenching. Right? So again, I think this is very useful type of evidence in this approach, even though it looks like a very simple data description approach at the outset. It's carefully done in a way that ultimately when you're done with it, you're thinking, well, I got to rethink the way I was thinking about capital structure as a result of this. So it's very informative to subsequent theory, because now any theory that comes along that purports to be modeling how capital structure is actually chosen has to deal with this sort of facts that are out there, these stylized facts that say how firms actually gain. That's sort of what I'm summarizing here. So any credible theories of capital structure kind of have to deal with this time series variation and not just focus on the cross-section anymore. It also is implying that, sort of contrary to probably what most of us teach in the classroom with respect to capital structure, that leverage per se is really kind of a second-order importance to valuation. And the firms behave as if they don't really care that much what their leverage ratio is at any point in time. If you're like me, you're teaching in the classroom, you're oftentimes teaching sort of a static trade-off sort of model where you're optimizing at this point that is the capital structure that maximizes the value. This kind of implies that either that nice inverted U-shaped curve that we draw up on the whiteboard for capital structure is either really flat, right, or it's total nonsense. One of the two. And third, then obviously, then what seems to be true then is that the main determinants of leverage ratios must be factors that are a little different than what we traditionally think of as sort of standard measures of taxes or distress costs that are traded off with one another. Okay, so let's move on to another different type of study. So those last two are kind of descriptive data analyses, right, that hopefully I've convinced you that they shed some useful light on the capital structure puzzle. Another way to go about this is to do a longitudinal type of study. And again, the potential merits of a longitudinal study is that you've got this long period of time where lots of things might be changing. Lots of the underlying factors that could determine capital structure can change over a long period of time, and we can see whether capital structures tend to change in the direction that we think they should, based on those changes in underlying fundamentals. So this study by Graham, Leary, and Roberts that's coming out in the JFE is a good example of that. Right? They're really looking at leverage ratios over nearly a century within the U.S. So you've got a period of time that's spanning World War II, the macroeconomic expansion that takes place after World War II in the U.S., high inflation period in the 70s in the U.S., the most recent financial crisis. All this gets spanned in their study, and they can ask then some fairly simple questions. First, have capital structures changed at all on average over that period of time? Secondly, can our existing models account for those changes? Are they consistent with those changes? And then third, if not, and the answer does seem to be no in this case, what underlying forces seem to be driving this variation? So again, when you approach the question in this way, the result that you're going to get, maybe you find that everything's consistent with what we thought. You usually don't find that kind of thing in reality. So if you don't, right, your end result is to present a set of facts that are a challenge to the existing theory. Right? They're going to inform theory. It's going to be useful in that sense. Right? It's also going to narrow the set of theories that are truly credible. Right? Any theory that purports to explain capital structure is going to have to account for this time series variation in leverage ratios that doesn't seem to be accounted for by our standard factors. So what do they find? Right? What they find is, first of all, that there's been a fairly large increase in leverage over time. If you go back to sort of the post-World War I period and look at average leverage ratios back then, I think, I'm trying to remember the magnitudes, but they're nearly double now what they were back then. Right? Coincident with that, you see a fairly large decline in cash holdings that coincides with this secular increase in leverage. Now, that may be surprising to some because a lot of what you read in the press and even in some of our studies in corporate finance in recent years talk a lot about these huge cash balances that U.S. firms have now. Right? That's a more recent phenomenon. Right? These cash balances actually were enormous back in the early part of the last century, and they declined quite a bit over the period of time in which these leverage ratios have gone up. It's only recently that the sort of cash balances have turned back up. Right? What's interesting, though, is that firm characteristics that we normally associate with capital structure, on average, don't really change significantly in a way that's consistent with these firms having greater debt capacity. So think of our traditional determinants of leverage. They don't account for the fact that leverage ratios are so much higher now than they were, back in 1920 or so. What's also interesting, I think, is that they do find a negative association between corporate borrowing and government borrowing, just in the U.S. And it would sort of give some hints at the possibility that there's some crowding out that's taking place. The government is borrowing a lot. That's crowding out the corporate sector from borrowing at reasonable rates. So again, once they're done with this, have they established any causation between variables and leverage? No. They're not claiming any such causation. Even with their last result with the government crowding out, the most they're saying is that there's some hints of that in the data, right, which I think is useful in terms of subsequent studies that could potentially examine that question in more detail. So This is again not a study that has great identification of anything, but I would argue is very useful to us as scholars who are interested in capital structure, because it's again narrowing the range of plausible explanations for what's going on. You finish this paper, you learn something that you didn't already know about capital structure. That's the definition of a contribution. Now, the last study I'll talk about is, again, one of my own, and I apologize in advance for talking about another study of mine. And again, I'm not representing these as the best studies. I'm just representing them as representative studies of particular approaches. So this is another longitudinal type of study that I've been working on with co-authors Lance Bargeron and Ken Lane, in which we're studying capital structure decisions of U.S. firms over a period of time that actually predates the Graham and Roberts paper. Our period of time is 1905 to 1924. Now, why study capital structure back in the dark ages like that, especially if you've ever looked at data back then? It's a little challenging to look at financial data for a period that predates the SEC. Standardization of data is not particularly good back at that time, but we thought, well, this is a very useful time period to take a look at for capital structure theories for two reasons. Right? One is that it spans the period of time in which the U.S. first introduced corporate and personal income tax rates. Right? So prior to 1909, I believe it was, there were no corporate income taxes. There were no personal income taxes either in the U.S. Great days, but not anything any of us have experienced. So if taxes are really important, then we ought to see it when taxes are introduced, was sort of the logic of things. At the same time, this spans this period of time in which the U.S. enters World War I, which we show in the paper is associated with a very large but short-term shock to investment opportunities for the U.S. firms. Right? Now, what's neat, we think, from an empirical standpoint, is that shock to investment opportunities is plausibly quite exogenous. No one's really anticipating the outbreak of World War I. Right? And so we can see how firms react to this shock to investment opportunities at the same time as that we're observing how they react to fairly large changes in personal and corporate income tax rates. Because one of the other things, I won't get into the details, but one of the other things that you see when the war breaks out is that the U.S. imposes very large excise taxes on the firms, particularly the firms that would potentially benefit from the outbreak of the war. So there's this very large change in marginal tax rates that actually gives a strong incentive to equity financing during the war. And so we're able, in some sense, to have a bit of a horse race going on between tax effects and dynamic investment effects. Right? So what we find in the paper is that there's really very little evidence that shocks to tax rates have much of an impact at all on the leverage ratios. You see these corporate income taxes initially imposed. Basically nothing happens to the average leverage ratios. Right? But what we do see, which is quite similar actually to the D'Angelo and Roll paper, is that even though average leverage ratios aren't changing very much, individual firm leverage ratios are bouncing all over the place during this period of time. And we're able to link it pretty tightly with the evolution of investment opportunities and cash flows in these firms over this period of time. Right? So our interpretation is kind of similar to the D'Angelo and Roll argument that it looks like the dynamics of investment opportunities and cash flows are what's really driving the leverage ratios rather than some of the traditional determinants of leverage. Right? But in trying to interpret this, there are challenges, some of which are closely related to the identification challenges that we've been talking about. One is that when you're doing any sort of longitudinal study, if you're going to focus in on specific shocks that interest you, you have to be aware of the fact that they're not the only shocks that are going on. during this period of time. So in our case, there's sort of a market panic that takes place in 1907. The Federal Reserve is created in 1913. And after the end of World War I, there's actually a pretty strong recession that borders on depression during that period of time, all of which could potentially have some impact on observed leverage ratio. So even though we can find some evidence that's consistent with this investment shock associated with World War I being a causal determinant of the leverage changes, we can't necessarily point to that unless we do something more. I mean, so where we are in the study now is sort of trying to supplement what we've got with a little bit more of a clinical analysis of individual companies. And that's involved actually collecting the annual reports from around 1917 for these 60 or so firms that comprise our sample. So as you might expect, they're not in most libraries, so you got to go, in our case, I go to the Columbia University Library, get these all copied, this huge stack of annual reports that we've got to go through. But it's a very useful way to try to tease out what's really driving these changes in leverage. Because now when you read these annual reports and the narrative that's in the annual reports, you can actually see the firms are saying specifically, we're borrowing in order to do this. Right? In that way, you are getting directly at the issue of causation in the data by using this supplementary clinical type of evidence. You don't have a clean natural experiment. You don't have instrumental variables. Right? But looking in the clinical sense, you are getting at some of the same issues. Right? In fact, I would encourage you to think about sort of clinical sort of analysis in the same way that you would think of as a natural experiment. Right? Both of them are identifying sort of a narrow situation in which you can fairly cleanly identify what's really going on. The natural experiment does it one way. The clinical study does it another way. A structural model, for that matter, does it yet another way. It's a very specific set of conditions. This is what happens. Right? All these are different ways of taming the same beast in a sense. All right, so let me just kind of conclude at this point, and we'll open it up to questions. The points I want to make, first of all, that these identification problems aren't going away. They're pervasive in corporate finance research. They're much more so in corporate finance research than in some other aspects of finance research. They're there. They're real problems. They're things we have to deal with as scholars in order to be able to tease out some sort of believable conclusion. Econometrics can help, and it's really helped. I think we've got great advances in our understanding of econometrics, like I said, over the last 10 to 15 years, and they really help us narrow down the scope of this problem. They can never solve the problem. Econometrics doesn't make the endogeny problem go away. It just sort of narrows the scope. Natural experiments are in some ways the most useful econometric solution, but I worry that an over-reliance on these natural experiments it can be harmful in our pursuit of knowledge in the sense that I described before, that it really kind of, if you think you have to have a natural experiment, you are constraining yourself in the types of questions that you can really ask. And if the profession as a whole were to do that, then we're constraining the body of knowledge that we're producing about questions in corporate finance. So I'd like to encourage you to think about these alternative methodologies that we went through as equally useful ways of expanding that body of knowledge, even if they're not able to really provide complete identification. And they frequently don't, but I would argue that's okay. As long as you understand and can explain the limitations of what you're doing, you can still produce papers that are very useful in terms of our understanding of the problems. Right. So let me stop there and open up to any questions. You can correct that using this simultaneous model, but that doesn't mean there isn't some other omitted variable you just have to specify. Okay then, well, thanks for listening. And,